Okay, I am recording this. There was a question from Anthony E. I won't use your full names, but he had a question about that he was looking for about a month holding time, and he thinks that there's a possibility, or wants to trade on the possibility of American Airlines going up. So what do we do there? Well, I would say that you're probably looking. Let's keep it as simple as possible, since you said you're relatively new to options. Let's look at a vertical spread. Need three pieces of information to see what we need to look at. 995 is where we're trading. We said that we wanted to go out for a month, so that's regular June. That'll be very, very liquid as well. Then we need the implied volatility for that. Implied volatility for the June expiration in American Airlines, is let's see, it is 135.96. High implied vol. So, given that, a 59% confidence interval targets somewhere just shy of 13.5, and a full standard deviation is $13.90, almost $14. So now we have to look at, okay, well, what, and I'm going to be careful here because this is a live trading platform. We go to June 90s. You can see where I got that implied volatility. And we're going to need some more strikes. So first, let's look at the 13, see if we can get a decent reward to risk there, because then we're targeting for less than a 59% confidence interval. So obviously, the closer to the money that you can get while still getting the requisite reward to risk, that's what you want to look at. So let's look at an 11.5, 13 call spread. It's trading for about 28 cents. We're going to have tight markets here. This is probably 26 bid without us at 31. So somewhere, let's just say we can get in at 28 cents. Well, now we go over here into the spread calculator. We know that we have the 11.5, 13. And we are going to do a simple call vertical. Buy this, sell this. And we said that we want to try and pay 28 cents for this. Where's the ideal place for this to go? Doesn't have to be Anthony that answers this. Ideal place for a vertical spread to go. There you go, Michael. Always with any sort of vertical, any sort of combination of verticals, which would be a butterfly, broken wing fly, even a calendar. The best place that you want to go is to your short strike, because that will minimize your exposure to your short and will maximize your benefit from owning that option. So in this case, best place to go is 13. So if we go to 13, we can make $1.50 on the spread. We have to pay 28 cents. So net, we can make $1.22. Reward to risk divided, we're getting 4.36. So what this is telling me is that we can move our strikes down, for one, because we don't need to get 4.4% reward to risk. Because most likely they're gonna, if American Airlines does go down or go up, it's probably because maybe there's some government-funded bailout or something like that. They're going to smash vol. So vol is not going to stay up at 135%. So let's roll down and let's look at the 10.5, 12. All right, get rid of that. And let's look at the 10.5, 12. 10.5, 12. That's trading for 44 cents. Still $1.50 wide. Put in our different strikes because we rolled down. 10.5, 12, not 105, Mike. So now we can make we said we would pay, let's say 45 cents for round numbers. So here we want to go to the 12 strike, a short strike. So now we can make $1.05. That puts us at 2.33 to 1. That's on the low end of where I would consider doing a vertical spread. I like to get them between 2.33% and 3%. So let's roll up. Let's do the 11, 12 and a half. Okay, so we know that we want to go to 12 and a half, but it's going to cost us a little bit more than the 11 and a half, 13. It's going to cost us a little bit less than the 11, 12 and a half. Why? So now we're going to look at the 11, 12 and a half. 11, 12 and a half. That's trading for 35 cents. Remember, we put a negative in this because we're paying money. So now we're getting about 3 1/4 to 1. That's the one I would do. So what are our risks? Our risk anywhere from 11, this is all at expiration. 11 or lower, we lose our 35 cents. $35 per one lot that we do. We already said that the best place to go is 12 and a half. And it can't get any better. If we go to 100, doesn't matter. We've capped off our possible reward because we financed our purchase of the 11 calls with the sale of the 12 and a half calls. We have to give something to get something. You can see we could never make more than $1.15 net on this. Sorry. That's the one I would do. 11, 12 and a half, try and pay 35 cents or better. We've been staying away from the airlines just because it's just so dependent on fundamental news that, we don't know that we're going to, we don't know what we're going to get. We don't know when we're going to get it. Usual market forces are going to not so much be in play as opposed to the next story. That's how I would approach it. Keep it simple. You got a good reward to risk. It doesn't cost a lot. You can invest as little as $35 on this thing. Okay? Any questions on that one? Yep. It's in the documents tab. Let me get that up there for you. Eric was asking all my spreadsheets. I don't keep anything from you guys. There's the link. If the link doesn't work, let me know and I'll repost it. Novia's kind of sketchy with the documents tab. That's why I put everything on the campus. I'll send you an email. I'll do a push. Any of that stuff. All right. Good question. I'm glad we got to run through that. And let's see if the markets wake up this afternoon. It's been kind of sleepy. And let's get off of the live. There we go. Okay, thanks for the question. I'm going to render this. Any thought on Walmart calls? All right, let me stop this video and get it going, and then we'll talk about what I think about Walmart.